Hi everyone, so it's just Tanya from Cannon and Co Sales and Lettings, back again with Emma from G3 Mortgages, talking about topics that are relevant to situations we've probably been in and that have come up during the weeks and things. So this week, or this episode, we are talking about self-employed mortgages. So this is something I was particularly interested in from going from my employed position to being self-employed, but I know a lot of others are in that position as well, and you hear lots of people on the street giving inaccurate information. I think everyone thinks they're an expert. Joe Blogs on the streets. So this is why we put these in front of you. So we explain with the expert being Emma. I am no means the expert in this at all, but it's just giving you the actual facts of what's going on. So Emma, let's talk about all things self-employed.
Yeah. So what you'll find is a lot of people will have the misconception that, you need 3 years accounts or, all of that sort of stuff to be able to get a self-employed mortgage. Whilst it's true that most lenders will want you trading a minimum of 2 years, there's many lenders that will go with 1 year's figures. Some may ask for a projection if you've got an accountant for the current year, depending on how far in the tax year we are.
Yeah.
We find that there's also a lot of lenders take the average of the last 2 years figures. So if you're a direct limited company director, you'd be looking at salary and dividends or salary and net profit after tax with most lenders. But there are also lenders that will use the latest year. So if you've got, for example, I don't know, you did last year, you spent a lot of money on plant or machinery or, buying stuff for your business. And then, the most recent year, you haven't done that. So your profit figures are looking really good. Lots of lenders can use the latest year's figures. They might ask the question, why should, especially if your profit's gone up more than 20%, they might ask the question, but as long as we go back and explain it, they have no issue at all. When we're talking about documents that the lender needs, if you're a limited company, they usually ask for the accounts. If you're sole trader, they will be looking for your SA 302s. So what that is, that's 2 documents. So there's a tax calculation and there's a corresponding tax year overview. And I find a lot of people don't know what these are. So if you've got an accountant, they will have those documents for you and you can just ask them for those. And a lot of the time I'll ask for the last 2 years, just so I can decide which lender we're going to. Do we need a lender that's going to take the average, or do we need someone who's going to take latest year? And then if you haven't got an accountant, you can log into your self-assessment account on the government website with your UTR number, and those documents will be on there to download. But it's you need both the documents, so they sort of work in tandem. So it's a tax calculation and tax year overview. So but I do find a lot of people don't know what they are.
No, because I think it's not something we look at. Like you say, we pay our tax, we get to the end of the tax year, but it's just being aware, isn't it? And I think this is this will be is really useful to raise awareness of what to look out for as well. And to be fair, we use it for elections as well. I know the referencing company that we use will ask and have that for self-employed for the referencing and things. So it's really useful to be aware of that document and how to locate it, I think, is key. Is there anything else we should be aware of?
I think with some people understanding the difference between turnover and profit. So a lot of the time I'll say to clients, what was your take home last year, for self-employed? What did you get? And they'll tell me a figure, say for example, I know £45,000. I ask for their tax calculation and tax year overview. It comes in and it's about half of that because that was their turnover. But what the lenders are going to lend on is your profit. And
so turnovers is what's like, I suppose, everything that's come in before bills and everything like that. But obviously the profit is what's left when everything's been taken out and everything, isn't it?
And it's that profit that the lenders are interested in.
Different. And it is a big difference. And I think that's what you don't realise. Obviously, we've all got insurances, everything to pay out. Like no matter what business I think anyone's in, there'll always be things to pay out and
travel,
bits. So,
stationery, all of that sort of stuff.
Oh.
So yeah, it's a big difference. And you speak to someone, initial call, and you say to them, what do you earn? And they go, oh yeah, 45,000 a year, great. Yeah, that mortgage will be no problem. And then you get the documents in, and it's like, oh no, actually, they actually earn about half of that.
No profit.
Yeah,
because
profit.
Let's be honest, the agreement in principle is only to kind of agree with the information that's been said, isn't it? It's only after that point when the lenders are going out to offer, and actually it's crucial. We don't get many that there are issues with, but it's being aware of all of these things that can pop up.
Yeah, definitely.
But yes, I found another useful episode. So thank you, Emma, and we will be back again for another one.